Hi, and welcome to the March 2019 quarterly video series for Forager Funds Management. I'm Steve Johnson, and I'm joined in this video by Senior Analyst on the International Fund, Gareth Brown. Hi, Gareth.
Hi, Steve.
We've introduced two new stocks in the March quarterly report, and both of them are suppliers to the automobile industry. It's been a record year of profits, and both of these companies are trading at very low multiples. It reminds me of the old adage that you don't pay low multiples of peak earnings for cyclical businesses.
Well, the reason being is that's often the time that industry players are investing heavily in capacity, setting up for future overcapacity and paying down the track. There are, however, situations where you can make money out of paying a low multiple. One of those is when the downturn turns out to be not as bad as expected, and the other is that when you're able to pick good companies that are able to grow despite the industry outlook.
And how would you classify the two stocks we've invested in?
The two stories are quite different. At the moment, the market is really quite scared about the death of the internal combustion engine, and our first investment, Canadian company Linamar Corporation, is quite exposed to that theme. Linamar makes parts like camshafts and gears that go straight to automakers' factories to be put into new model cars. And so if the internal combustion engine does disappear, it could be quite painful.
And you obviously disagree with that market concern?
I think there are a few salient points to make here. The first is that it's actually the growth in the total number of cars that's shifting away to new forms of engines like electric vehicles. So the total amount of internal combustion engines to be made over the next 10 years is still likely to be quite high, although it will shrink gradually, particularly at the back end of that. The other point here is that the automakers have been outsourcing more and more of the drivetrain to tier one suppliers like Linamar over decades, really. And we expect that trend to continue and actually, if anything, accelerate as the automakers start pulling back on the amount they're prepared to invest in the old combustion model.
We met with Linda Hasenfratz, who's the CEO of this business and a member of the founding family in Detroit on a recent trip, and what really impressed me was a very, very strong focus on return on capital in this business. The actual equipment that they use has a relatively short shelf life, 5 to 8 years, and it's quite flexible. They can use it to make and design lots of different things. And she and the whole business seem very, very focused on making sure that they are getting appropriate return on capital. And I think that is important in a business like this that's going through quite a lot of change.
And I think it's worth pointing out that a lot of the investment in recent years has been outside auto altogether. The company has almost for 2 decades owned Skyjack, which makes scissor lifts and telehandlers, which are used in the infrastructure business. It's one of the largest producers of that kind of equipment in the world. And more recently, they bought MacDon, which is also a Canadian company, and it makes specialized agricultural equipment. So these are two quite important parts of the puzzle.
And what about valuation?
The stock's really cheap. It trades on 5 to 6 times earnings, and we think this is quite protective. It means that it generates a lot of cash flow that can be invested in new parts of the auto industry and also outside the auto industry altogether.
And the other new auto-related investment in the portfolio is Lear Corporation. Can you tell us a little bit about that investment case?
Lear makes seating systems that get sold to car makers to put in new model cars. And this part of the business is much more outsourced than the drivetrain business. And there's really 4 players that dominate this globally, and it's allowed Lear to earn really quite high returns on capital.
And how does this one stack up on valuation?
It's in the auto industry. Auto industry is always going to be cyclical. But whether you have a car that runs on an electric battery or whether it's got an internal combustion engine, you need seats. And so we don't anticipate any major changes in the ecosystem there. So Lear trades at a higher multiple than a stock like Linamar, but it's still pretty cheap, and generates a lot of cash, and management have a history of returning most of that cash to shareholders.
That capital allocation piece is a really important part of our thesis here. Lear's been paying healthy dividends for most of the past decade. It's also used its excess free cash flow to buy back almost half of its outstanding shares, which has had a big impact on the earnings per share. It's obviously an industry with a very divergent range of opinions at the moment. These are some early investments for us, and we think they're going to be some very important ones over the coming years. We'll be watching very, very closely and looking to increase or reduce our investments as we monitor results over the coming years. Thanks for watching.